Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Chevron. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today we're going to look at Chevron. We're going to do another fear of missing out trade. We're going to basically go back to the well. We've already had a fear of missing out trade on an energy company starting at the beginning of the year. And I think we're going to repurpose it. And it's going to be in honor of Warren Buffett's swan song that he did this weekend. Warren is over 90 at this point in time, and he hosted the annual shareholders event for Berkshire over the weekend, and one of the companies that he talked about was Chevron. Chevron, they've had a position in for quite some time, sold a little bit of it off, and then came back and bought some back. So in honor of that meeting, we're going to do a fear of missing out trade in Chevron, because I still think that with the energy companies, we're a little bit nervous about the fact that they've had such a good run-up. It's been a real good sector in this environment, in an environment where there just hasn't been that many good sectors. Now, as always here on the Stock Play of the Day, nothing's meant to be a recommendation. We're just going to try to learn how we can take all the 40 different plays that are mentioned in the options playbook and find scenarios where this play may be better than that play relative to market conditions. So let's start by talking a little bit about the market. So I'm going to go to the VIX watch list that I have inside my Ally Invest account, and we'll see. We've been talking about the VIX for quite some time. The VIX is right now at 3039. For the longest of time, and I'm going to highlight it here on the chart, the VIX was just hanging out at the beginning of April, right around that 20% level, and we mentioned it a lot on the Stock Play of the Day as the fact that we were a little befuddled as to why the volatility was so low, considering all the different concerns that the marketplace had. We have geopolitical concerns, we had rising interest rates, people have been talking about possible recession, and yet the VIX, the fear index, if you will, was still hanging right around that 20% level. Well, that's no longer. We did get the spike up in the VIX. The VIX recently went as high as, it looks like, right around 36, 37. But I have drawn on this chart kind of the line in the sand that has been high volatility since the markets have started to come back after the pandemic. So to go all the way back to the pandemic, you see obviously the huge run up in the VIX as we had the big downturn in the marketplace. Since then, we've came up and touched the 40 level only twice. Here's one time where we kind of went a little bit higher, almost got to 45 on the VIX. This is back in the middle of 2020. We touched the 40 line, and we haven't been back there since. Now, the VIX trading around 30 makes more sense to me than trading around 20. We do have a Fed meeting, which we're going to talk a little bit about here shortly. That can also drive up VIX valuations just going into the Fed meeting. But if we want some capitulation in the marketplace, I wouldn't mind seeing a little bit of a downturn in the market from where we're currently at and get a little bit more of a pump up in the VIX and try to flush out all the sellers. If I look at the S&P 500 index chart, we see right down around this 4,000 level in the SPX. Obviously, the chart is ugly, so there isn't too much to talk about as far as the chart, except for the fact that it is ugly. If we get down to the 4,000 level, we're looking at we're going to be approximately 20% off the highs in the SPX, which would be officially a bear market. I think a big question will be, will we get that bounce at that 4,000 level? If it does come down to there. If not, we're still just going to keep in this choppy marketplace and wait for something to change to try to spark the marketplace and try to drive us higher. but I do think that that is a very important level. I have it highlighted here on the SPX chart. And if we did see the market come down towards the 4,000 level, see the VIX spike up towards the 40 level, maybe that's an area of capitulation. Obviously, you can't just weigh it on two factors. Consumer sentiment is fairly good. We still have decent earnings. Growth kind of took a little bit of a hit recently, but all eyes are going to be on the Fed this week. And mainly, right now, the marketplace is expecting a 50 basis point increase, and they're mainly going to be looking at what's coming up next. Are we going to stick with another is the Fed going to hint towards another 50 basis point increase at the next meeting? I think everything's going to be on how Powell addresses the marketplace and see if they can get any bits of information about the outlook going forward into the year. Interest rate, the 30-year is really battling to try to stay below the 3% level on the 10-year. So with all that going on, all the eyes are really going to be on the Fed this week. Obviously, you always have a third eye on the geopolitical concerns that are going on over in Russia. That's obviously hurting the world economy, especially with food prices and inflation. And if we could ever get a little bit movement in the world, they're not even talking about a ceasefire at this point in time. But obviously, I think that would give a little bit of relief to the marketplace if we could get some headway into some closure on that front. All right, so the one sector that's really been sticking out as a winner since the beginning of the year is the energy sector. And we're going to talk about Chevron today, mainly because of the discussion that we had over the weekend with Berkshire Hathaway and some of Warren Buffett's comments. So why not look at another solid energy stock? The last one that we talked about was a little bit more speculative. It was on Marathon Oil, which is also in the refinery space. But Warren, Mr. Buffett, I should say, give that type of respect, talked a little bit about how they were in and out of Chevron, always had a position in it, bumped up the position earlier in the year. It represents, I think, approximately 2% of the Berkshire Hathaway portfolio, which is nothing to sneeze at. That's obviously a very large percentage, a lot of shares of stock. And if I look at the chart, we had a great run up here. We're looking at in 2022 from March on up. It was a very, very, very strong move. Hard to fight that move, but we've had a lot of chop and we've sold off a little bit. Most of the energy companies have announced earnings. Chevron announced on the 29th, and we really, if I didn't tell you that by looking at the chart, it would be really hard to determine because not much has happened at all. We see that the 50-day moving average is right, basically support and resistance, and it's really just humming along right at the 50-day moving average. We're a little bit overextended as far as the 200-day moving average, all the way down at the 124 level. Stock right now is trading at 162.61. So because of those concerns a little bit and the choppiness of the marketplace, I think that if I was considering to jump into the energy space, that's why I said I'd like to come back to the well as far as the title of today's event and think about using longer term options as a substitute for the stock. And by doing that, we're going to have limited and known risk to the downside. And we have a solid play as to how we want to approach this energy company going into, we're going to go out fairly far in time. We're going to go out over 100 days in time. So we're going to look towards the end of the summer and see how it all plays out. So the strategy that we're going to look at today is buying leap options. Now, I have it inside the Options Playbook website right now. We're highlighting actually the Rookies Corner. We build this as a trade to get your feet wet in options. And the concept is that we're going to go deep in the money. We're going to buy something that has a lot of delta, and I'll talk a little bit about what having a lot of delta means. And it will act as a surrogate or a substitute for the stock. Now, you don't own the stock outright, but we're going to buy an expensive option contract that has a lot of real value or intrinsic value, and it will act a lot like the stock. As the stock moves up, so will that option contract, right in line with the stock or fairly close to it. So we're going to go deeper in the money, further out in time. Now, if you look at and I should highlight this, I always sometimes skip over it, but LEAPS call options just means, that's just a fancy marketing term. Chicago Board Option Exchange decided, instead of calling it a longer term option, they call it a long-term equity anticipation security, and it becomes the acronym LEAPS, so just a fancy marketing ploy. But it just means we're going to go on longer term options, and usually LEAPS mean that you're going to go out more than nine months in time. We're going to use the concepts that are in here that talk a little bit about buying 80 delta. If you scroll down, you will see the 80 delta somewhere inside the body of the article, right there. I'm going to highlight it. And we're going to just go out about 100 days in time. So let's look at that strategy. We'll talk a little bit about that, and we're just going to buy that LEAP option outright, as opposed to doing what's called the fig leaf, which we also highlight that in the Rookies Corner in a little bit more advanced trade. But we're going to come back on Friday on the stock play of the day overtime, and we'll talk about, well, if we did have a profit in the position, how can we take some money off the table by selling a shorter term out of the money option against that, and that creates a strategy in the playbook that we call the fig leaf. And I'll let you look for that or look it up on your own. So before I get into the strategies, I want to highlight that this is an interactive show. Part of the reason why we love to do it here on the Ally YouTube channel is because we can open up that chat box and answer any questions that you may have. So if as I'm talking, something doesn't quite hit home, please make sure you make note of it and put that question in the chat box, and I'll try to address them here at the very end of the show. Okay. Here is the Ally Invest option chains. We see that Chevron is up strong today, and a lot of the stocks that Mr. Buffett talked about over the weekend have had a good couple of days of trading. Very interesting. He had no holds talking in his final investor relations conference that he had for Berkshire Hathaway. So it was very interesting to be able to see it. You could watch it. It was simulcasted as it was going on. So with Chevron right now, we're at 162.78. We're up $3.07. The expiration dates, we have a plethora of them available. We're going to go all the way out to the August 19th expiration. We highlight in the change that that's 108 days. We're going to focus on the call side of the chain. We're not looking to buy puts. We're going to limit our risk. If we were to buy the stock outright on $162 stock, we round it up to 163. That would be $16,300 to buy 100 shares of that stock. We're going to limit our risk to about 15% of that. We're going to buy an expensive option contract, but I've highlighted on some of these energy stocks, especially like in Marathon Oil, one of the reasons why people are trepidatious to do this strategy is the width of the bid-ask spread on deeper in the money option contracts. When we looked at Marathon Oil, we highlighted that the width between the bid-ask spread was decent. There's never going to be as good as the stock, but it was decent. And also, I would say that it's decent here in Chevron. The paper trade for this week is going to be buying the 140 strike call, about $23 in the money. We're going to buy the 80 delta, which means that if the stock goes up 1, we're hoping that this option contract will make about $80 for every one contract that we make, hence go up about 80 cents. Now, it's a dynamic number in the options trading world, so this is just, it's theoretical, it's not always exact, but it gives you a feeling for what the option might move relative to the movement of the stock. Now, whenever we do a FOMO trade, we always bill it as, if you were thinking about buying 100 shares, you're going to buy one call option. If you get a little frisky, you might go out and buy 2 call options, but obviously that would double your risk comparative to just buying 100 shares of stock outright. By buying this option contract and paying $26, well, it's 26 by 26.50. We have a little bit of volume today, a little bit of open interest. You're going to I don't know if you could go right at the midpoint. I think we'll work the order and we'll say 26.40. So that means that we would be paying for one option contract $26.40 or $2,640. Now, representative to buying 100 shares of stock and the cost on that, you're looking at about 15% of the total cost. And a lot of times when I'm targeting these, and I like to call them FOMO trades because the stocks had a good run up, a little bit nervous about it, still positive in the energy space. That would be your mindset, that you still like the energy space, but you want to have limited and known risk on the downside and still have the potential on the upside. So this is one way that you can use options to limit your risk and reduce it and still give you exposure to a company that you would like to be exposed to. In this instance, it's going to be Chevron. All right, so I'm going to scroll down and we'll look at the strategy in the workbench and we'll put it in the right rail and we'll make this the official paper trade. The midpoint right now is at 26.70. I think, well, 26.40 came down. I guess we'll go 26.30. So I click trade, it pops up in the right rail. And here's the trade. We're buying to open. Well, let me put the limit in, 26. Click on that and it puts the midpoint into the limit box. And we'll go 26.30. Now, whenever we're trading options, we're always putting in a limit order. I very, very, very rarely, except for maybe when I'm trading extremely liquid underlying like the SPY, the ETF that tracks the S&P 500 index, enter a market order. I'm almost always limiting the price that you're willing to pay and trying to work the order, mainly because of things that I've already mentioned, that I don't care if you're going deep in the money, at the money, or whatever. The options marketplace just is not as liquid as the underlying stock. And it's a derivative. There's a lot of different options that are available. You have many different strikes, many different expirations. And because of that, you're going to almost always have wider bid-ask spreads than you would if you were trading the stock outright. Okay, so our limit here, God, it came down a little bit. Let's go, I like 26. It's right at the midpoint. So the midpoint right now is 26. Usually when we're doing the show, it always seems like the stock has a tendency to run up. And it's just kind of nice now. So 26 is a real solid number. It'll make it easy when we do the overtime show on Friday. We're going to put it at a limit price of 26. Midpoint fills are never guaranteed, but this is going to be the play, the paper trade for this week. Buy to open, 1, August 19th, 2022 expiration, 140 strike call at a limit price of $26, good for the day. And we're going to let that order work. Okay. So, if I'm looking at this trade and I think about how Delta works, what this means is that if we were to execute at $26, we see Chevron go up by $1. If we had 100 shares of stock, we would expect to make $100, right? $1 times 100 means you're up $100. In the options world, if the stock does go up and you have an 80 delta, you actually, the option contract usually represents 100 shares, which is the case in this option contract. And if it goes up by 1, you'd expect the price of the option to go up by about 80 cents. Take that times 100, you look to make about $80. So you're making 80% of the stock price movement. There's many different ways that you can say this. Now, one of the things that I like about doing a fear of missing out trade, and I'm going to try to highlight this. Now, I'm going to use real options to try to give you a feel for the pricing and what might happen if Chevron goes up and if it goes down. So we always put a stop in about right where the strike price is at, 140. Your total risk is about 15%, but we would want to get out before we would ever get down that percentage on it. Now, if I did the underlying stock and it went down $23, well, that would be a real loss. What's nice about the options world is we pick up delta as we get deeper in the money. So in this instance, if the stock keeps going up, our option acts more and more like the stock and gives you more and more stock price representation, all the way to the point where delta would get deep in the money enough that delta would represent 1, basically saying that it is acting 1-for-1 with the stock. Stock goes up 1, the option contract goes up 1. Now, it's important to note that it is a derivative. It's very rare that the option contract is not going to go up, in theory, more than what the price that it's derived from. So you shouldn't get more for buying the option contract. If the stock goes up 1, you see the option go up 1.25, right? That just in theory doesn't make any sense. So that's the way it works on the upside. Now, if the marketplace comes down, what we see is that it actually slows down. The losses against you, it goes against you slower when you're incorrect on your forecast. It goes with you faster when you're correct, slower when you're incorrect. So let's say we just put this position on right now. I'm going to run to the option chains, look at the call chain. I'm going to focus 162.95. Okay, let's call the 160 strike the most at the money strike. That's trading for $13. So if we put this trade on today and the market went down about $23 down to 140, I would expect that option contract to be trading right around the 160 level. Why? Well, the 160 level is basically an at-the-money option contract right now. If it went down to 140, this would be an at-the-money option contract, and it should trade for approximately what the 160 call option is trading for right now. Now, that's a little bit in the money. I mean, we could say the 165 should be somewhere between $13 and $10. Now, as expiration approaches, there is going to be time decay. This is a snapshot of the marketplace right now. But keep in mind that if I did this trade and we got 100 days out, over the next 30 days, it got down to the 140 level, that's just a natural place to sell your option contract and get out on the downside. Now, you can say to yourself, well, I'm paying $26 for this option, and if I pay $26, I only want to lose half. That's another way to look at it and say, when it gets to 13, I'm just going to get out. That would be about 8%. There's a lot of investing rules out there that say never lose more than 8% on any one stock in your portfolio. Those are more so for swing trader type people, not people like Warren Buffett that just like to buy and hold for the long term. But that is one way to approach your portfolio. Fear of missing out trades like buying deep into money leap options as a substitute for the stock allow you to manage that risk quite well, especially if we have decent markets to trade in. Now, if these were 1 cent wide markets, I don't think almost everybody would be trading options and hardly anybody would be trading stocks. Why? Well, because you can manage your risk that way. It makes it very plausible. One of the hardest things to do in the stock trading world, and I think right now is a great time to talk about this, is to just get out of a loser. You have a stock that's going against you, and some stocks just don't go up forever. And in that instance, sometimes some of my better trades, I think, were ones where not necessarily I was correct on my forecast. Those trades are easy. But where you were incorrect on your forecast and the underlying market is going against you and you were able to pull the trigger and sell it and get out and stick to your plan, and then the stock continued on down more or went down precipitously from that point in time. Those are the trades that I'm proud of as an investor, as an option trader. All right. So I'm going to run over and look at the chat box right now. And if we have any questions, please put them in the chat box. Not seeing a lot in there right now. So I'll give it a couple of minutes. We'll talk a little bit about the fig leaf trade. And I'm just going to stay right there, but I'm going to pop over to the playbook here in just a second. But let's stay on this right here. And I'll bring up the fig leaf trade. In other words, I'll do a little foreshadowing as to what strategy we might talk about here on Friday on the stock play of the day overtime. And fig leaf is an interesting trade that we actually coined inside the options playbook. It was a very popular strategy that we never that never had a name, and I thought it deserved a name. It's probably one of the most popular strategies as an alternative to a covered call. Covered call is, in my mind, the most popular strategy in the option trading world. A lot of people might think that it's just buying calls outright or buying puts outright, but I see the traders over the years that are doing covered call writing stick with it a lot longer than some of the people that are just speculating just by buying calls and just by buying puts. And I mean, there's a lot of caveats to that, what I'm saying, but the fig leaf is what we're going to be looking at on Friday, just as an alternative. No matter where the underlying stock is at, we'll look at selling a shorter term call against our longer term option position. All right, so a couple questions popped up. All right, Charles, what would a fig leaf spread look like on this play? All right, there you go. Short-term strike. Well, the short-term strike, if I want to always sacrifice premium on fig leaves to go up in strike. So where I'm doing a covered call, let's say on a $160 stock, maybe I'm looking to try to bring in a dollar or so on a fig leaf, I might be okay with 50 cents. Mainly because I'll go up a little bit higher. I didn't have as much capital in to start with. It'll be a higher percentage of the strike. And I'm obviously going to avoid earnings, but we already had earnings in Chevron, so makes it a little bit more feasible to look at a fig leaf right now, because I just don't want to be in a position and have a known news event that could either drive the stock a lot higher or a lot lower. All right. So come back. You're going to have to come back Friday to get to the exact expiration, Charles. Tom, what do you think about out of the money options? Out of the money options, I actually have a white paper that I've written, and if you Google my name and Google top 10 mistakes, it comes up. And one of the biggest mistakes is people buying out of the money options as their, I guess, most liked trade or most often done trade. I don't mind them in certain conditions, and this is what this show is all about. We've talked about buying out of the money options in certain situations. We don't do it that often, but there are some times where I think it might apply. So as a one-off trade, I don't mind it as much, but because of the way options are priced, it's very possible to buy out of the money options, be right on your forecast, but lose money on that option trade. And that's really tough to take in. So I do have, and we'll probably end up doing this webinar. We talked about it a lot in the rookies course. The part 3 of the rookies course on the Ally YouTube channel talks a lot about buying in, at, and out of the money option contracts. Actually, it's an hour-long event. Rookies course 1301. All right. What do you think about NOHO stock, GTE stock? I got out of GTE for now, but I'm still in NOHO, NOHO, even though I went down a bit. Okay. I don't necessarily try to give recommendations, because we're really not supposed to on the show, on any particular stock. I think one of the biggest things, if you're going to trade stocks like that, is to definitely have a plan and stick to the plan. Get your buy price in. These stocks to me are a little bit more of a swing trading stock, and you just want to have a plan, have a stop price, get out, and if you get out at that stop price, do yourself a favor and stop getting quotes on it. Move on, find another stock, and do your trade. So it's a little bit different trading when I'm looking at trading stocks like NOHO and GTE. Okay. I think that's it. That's all we have, and we're right at time. So that's it for this edition of the Stock Play of the Day. We're going to come back on Friday, see how the Chevron trade is doing, and talk about potentially making this position a fig leaf inside the portfolio. Thanks for coming, everyone. Please click subscribe, ring the bell. You'll get all the alerts all the alerts for everything that we do on the Ally YouTube channel. Thanks for coming.